Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. We have come to an end of the last topic for this semester, which is on understanding accounting and business funding. So you may refer to the textbook chapter 15. Chapter 15. Okay. Let's take a look at what is accounting. What does it mean by accounting? Accounting is actually the process of recording financial transactions. Financial transactions pertaining to a business. So if you look at the definition over here, it's a comprehensive system for collecting. We collect the data on the transaction, we analyze the data on the transactions, and we communicate financial information to the firm's owners. So the financial information that we have collected, we have analyzed, we communicate it to the firm owners, the managers, to the employees, to the public, and to various regulatory agencies. So this is the meaning of accounting. So it is actually a language that gives us the information about the financial status of the business, of the organization. Alright, so it measures, it summarizes, it records, classify, verify the information, then communicate the information to the users of accounting. Okay, alright, so other than communicating the financial information to the users of accounting, this accounting also will make the company understand of the financial position of the business, so that they can make other decision in the company. And then it allows the company to analyze the financial performance of their business and looks at statistics such as the net profit that they gain. Alright, so who will keep the records of this accounting? He or she is the accountant. They will keep records of taxes paid, of income received, and expenses incurred in the business, in the company. So this process is called bookkeeping, the record of accounting transactions. Bookkeeping is very important in a company so that you know the flows of the money in the organization. Alright, so this bookkeeping is actually a process of recording transactions in an accounting system. Previously, it has been done by hand. You keep it in a logbook. You write it. You write the data, credit, debit, and so on. But nowadays, we are using the computer system, which is called as accounting information system. Later on, we'll look at what is it. So accounting is very important, because without accounting, the accountant, the financial system, they will not know the profit or loss of the company, the debt that the companies have. Alright, so by sorting and analyzing the transactions of the company, these accountants, they can determine what I have earlier told you. They will know how is the business going, how to manage the business, how well the business is being managed, alright, how financially strong the business is. So that's the importance of accounting and accountant. Alright, we should have an accountant. Sometimes usually the small companies accountant is the owners of the company themselves. Alright, but you need to know the at least the basic accounting, so that you will know on how to deal with the transactions. Okay, alright, and then When we talk about accounting information system, and nowadays most of the company they will have this accounting information system. It is actually an organized procedure for identifying, measuring, recording, and retaining financial information for use in accounting statements and management reports. Okay, it includes all of the people, okay, reports, computers, procedures, and resources that are needed to compile financial transactions. So everyone can, especially the person in charge, the one that can access the system, they can access, they can uh, look at the current status of the financial of the company. Okay, so next we'll talk about the uses of accounting information. All right, so who will keep the records of this accounting? Okay, he or she is the accountant. They will keep records of taxes paid, of income received, and expenses incurred in the business, in the company. So this process is called bookkeeping. The record of accounting transactions. Okay, bookkeeping is very important in a company so that you know the flows of the money in the organization. All right, so this bookkeeping is actually a process of recording transactions in an accounting system. Previously, it has been done by hand. You keep it in a logbook. Okay, you write it, you write the data, credit, debit, and so on. But nowadays, okay, we are using the computer system, okay, which is called as accounting information system. Later on, we'll look at what is it. Okay, so accounting is very important, okay, because without accounting, okay, the accountant, the financial system, okay, they will not know the profit or loss of the company, the debt that the companies have. All right, so by sorting and analyzing the transactions of the company, okay, these accountants, they can determine what I have earlier told you. Okay, they will know how is the business going, okay, how to manage the business, how well the business is being managed, all right, how financially strong the business is. So that's the importance of accounting and accountant. All right, we should have an accountant. Sometimes usually the small companies accountant is the owners of the company themselves. All right, but you need to know the at least the basic accounting so that you will know on how to deal with the transactions. Okay, all right, and then when we talk about accounting information system, nowadays most of the company they will have this accounting information system. It is actually an organized procedure for identifying, measuring, recording, and retaining financial information for use in accounting statements and management reports. Okay, it includes all of the people, okay, reports, computers, procedures, and resources that are needed to compile financial transactions. So everyone can, especially the person in charge, the one that can access the system, they can access, they can uh, look at the current status of the financial of the company. Okay, so next we'll talk about the uses of accounting information. Okay, next we'll take a look at who are the users of accounting information. Basically, we have 5 users of accounting information. Yeah, they are business managers, employees and unions, investors and creditors, tax authorities, and government regulatory agencies. But basically, these 5 uses of accounting, it is divided into 3 fields of accounting itself. Okay? Fields of accounting, which are managerial accounting, financial accounting, and tax accounting. But in this textbook, we'll learn on financial and managerial accounting only, in which we'll cover that financial and managerial accounting, the 2 main fields of accounting, later after uses of accounting. Okay, the first the first field of accounting is managerial accounting, which consists of business managers and employees and unions. So they are at the managerial level. Okay, so at this stage, okay, usually they will tell the truth, that will help the manager make the right decision. So business managers will use this accounting information. Okay, so the accountant, they need to tell the truth. Okay, so that the managers will make the right decision. Okay, so usually business managers or business owners, they will use this accounting information to develop goals and plans, future plans. All right, so if they know the current status of their financial and their finance, they will know what to plan next, based on the financial status. They will use it to set budgets, and evaluate future prospects. That's the use of accounting information to business managers or business owners. Next is employees and unions. They use this accounting information to plan for and receive compensation and such benefits as healthcare, vacation time, retirement pay. Okay, so the employees and unions, they need to know the current status of the financial and the financial status of the company. Okay, you will not apply for a company that will close down in the near future, for example, in 2 months' time. All right. Okay, you will look for a stable company, with a stable financial status. So you will get all those benefits, the compensation. You will need to plan for it. Okay. All right. So that's the use of accounting information to employees and unions. Next accounting users are investors and creditors. Who are these investors and creditors? Okay, they are usually the stockholders, all right, or the bank institution. Okay, creditors are bank institutions. Okay, why they need this accounting information? Okay, they want to estimate returns to stockholders. If they want to invest in your company, they need to know the financial status of the company. All right. Yeah. Other than that, they want to use the accounting information to determine the growth prospects. All right. So let's say basically, let's say this year they will get this percentage, and next year it will grow. All right. And decide whether a firm is a good credit risk. If the bank, that you want to borrow, let's say, money from banks, they need to know the financial status of the company. All right. So usually for this one, you will need to tell the truth as well. Okay. This falls under financial accounting, for investors and creditors. All right. And usually the investors and creditors, they love to see the profit and performance of the company. Then they will invest. They will give. They will allow you to borrow money from banks, to lend you more money. All right. So usually at this stage, for investors and creditors, you will need to tell the truth. Right. Next, users of accounting is tax authorities. Who are the tax authorities? In Malaysia, our tax authorities is LHDN. Alright, Lembaga Hasil Dalam Negeri. Okay, so they are the tax authorities in Malaysia. So this actually falls under tax accounting field. All right. Okay, so tax authorities to plan for tax inflows. They use the accounting information to plan for tax inflows. Okay, they will determine to tax liabilities of individuals and businesses and ensure that correct amounts are paid on time. Okay, so they will use the information to come up with the amount of tax that you need to pay. The company need to pay. All right, and usually, the company they will try not to tell the truth on the amount of profit that they gain, so that they will reduce the tax. All right, but this is illegal, actually, right? But there are companies that will do that. Not all, not saying all companies, but they are okay out there. All right, the last users of accounting information are the government regulatory agencies. Okay, so usually you will need to tell the truth about the financial status, but some of the company, same as tax authorities, they will disclose the maybe less than what they get for the profit. Okay, so they need actually they need to show low profile and poor performance, right? Some sort of poor performance or less performance than before, because if they reveal the exact amount of profits that they gain, they will be taxed with higher amount of tax. All right, because higher profit, okay, higher the taxes. Right, so usually the government agencies, government regulatory agencies, they use this accounting information to fulfill their duties toward the public by requiring firms to file financial disclosure. Okay, and then to allow potential investors to have valid information about their financial status. Okay, so usually the government, they will provide the information to potential investors in Malaysia, in the company itself, in the country. That's why we need to report the accounting information and the financial status of the company to these government regulatory agencies. Okay, so that's about the uses of accounting information. Next is on financial versus managerial accounting. Okay, what is financial accounting? What is managerial accounting? Okay, financial accounting and managerial accounting are two of the four largest branches of accounting discipline that I have explained to you earlier. Okay, we have financial accounting, we have managerial accounting, we have tax accounting, and one more is auditing, actually. But then we'll just learn on these two these two accounting types of accountings. Okay, the two fields of accounting, which are financial and managerial accounting. Okay, there are many similarities in approach and usage of these two accounting, but there are still significant differences between these two. Okay, most of the time the differences is around the compliance, the accounting standards, and the target audiences of the accounting. Okay, so let's talk about managerial accounting first. What does it mean by managerial accounting? A field of accounting that serves internal users of a company's financial information. So its main objective is to produce useful information for a company's internal use. Okay, so usually business managers collect information that encourages strategic planning, helps them set realistic goals, and then encourages an efficient directing of company resources. Okay, so usually they will use this managerial accounting, use this information to make departmental decisions, to monitor projects and to plan future activities. As compared to the financial accounting, what is financial accounting? Field of accounting concerned with external uses of a company's financial information. Okay, it has some internal uses as well. Okay, but it is more concerned with informing those outside of company. Okay, that is financial accounting. Okay, it is used to deliver accounting information to the investors, to the creditors, all right, to the investors, creditors. Okay, um, usually for this financial accounting, they have the financial statements. They have the financial statements produced through financial accounting, and this is designed to disclose the firm's business performance and the financial health of the company. Okay, so if managerial accounting is created for company's management, right, financial accounting is for investors, creditors, and industry regulators. Okay, so I've explained to you earlier the uses of the financial accounting and the managerial accounting. Next is on accounting equation. All right, so what is accounting equation? It is considered to be the foundation of the double entry accounting system. All right, so this accounting equation shows a company's balance sheet. All right, it is a company's balance sheet where the total of all the company's assets equals the sum of the company's liabilities and shareholders' equity. Alright, so the equation is assets equals to liabilities plus owners equity. Alright, basically for this accounting equation, it should be, it should always balance out. Alright, the left side and the right side should be balanced. Okay, assets should be equal to the liabilities and owners equity. Okay, so for this accounting equation, let's take a look at the what does it mean by asset, what is liability, and the shareholders equity. Asset is any economic resource that is expected to benefit a firm or an individual who owns it. Okay, so it includes cash, okay, cash equivalent or liquid assets, okay, accounts receivable. Okay, accounts receivable is the amount of money owed by the company by its customers, okay, for the sale of its products and service. So someone or some organization owed you, all right, money, okay, because they purchase a product or services from you. Okay, inventory is also considered as an asset. All right, we have merchandise to be sold. What else? It is actually what a business owns. All right, or what is owed to it. Okay, supplies, equipments, lands, the intangible items as well, patents, copyrights. All right. Okay, next is liability. What is liability? A debt that a firm owes to an outside party. Okay, what a business owes to other. What you owe to other business. Okay, so what you need to pay to keep the company running. So debt include the long-term debt, all right, as well as rent, taxes, utilities, salaries, wages, dividend that you need to pay, all right, payment to be made to suppliers, what else, mortgage and loans, interest payments to financial institution. All of these are the liabilities. And then we have shareholder equities, or we call it as honest equity. Okay, money that owners would receive if they sold all of the company's asset and paid all of its liability. That is honest equity. Honest equity is equals to assets minus liability. Okay, so it can be called as net worth. All right, so honest equity. Okay, so it represents the amount of money that would be returned to you, all right, if all assets were liquidated and all of the company's debt was paid off. That is honest equity. Okay, the money that you as a business owner, have put into the business. All right, it includes honest claim. All right, um, the assets. So for honest equity, it is the assets minus liabilities. All right, it is the total asset that you have minus the liabilities that you have. Okay, so that is accounting equation that we need to know. Let me add on the honest equity. Okay, so in honest equity, we have paid in capital and retained earnings. What does it mean by paid in capital? It is the money that is invested in a company by its owner. Okay, capital paid in by investors. All right, owner or investors during the common or preferred stock issuances. Okay, that is paid in capital. Okay, so usually the company received the capital from stockholders when the company issued its stock. Okay, so the funds raised by business from equity and not from ongoing operations or selling shares um, um, or bringing additional investors. So that is paid in capital, what has been invested earlier. Okay, so what is retained earnings, or we call it as net profits? Okay, retained in earnings is after you minus the dividends to the stockholder. Okay, so after a successful earning period, a company can pay some of its income to shareholders as dividends, and they will keep the remainder as retained earnings, the net profits of the organization. Yeah, so that's the what does it mean by paid in capital and retained earnings. Another financial statement that we have is income statement, or we call it as profit loss statement. Okay, as the name implies, profit loss, it is the revenues minus the expenses. Okay, so you will get the net profit. Okay, so it is actually a description of revenues and expenses result in a figure showing the firm's annual profit or loss. So, and this income statement, it is divided into four major categories, which are revenues, cost of revenues, operating expenses, or we call it as OPEX, and net income. So let's take a look at revenue. What is revenue? It is the funds that flow into a business from the sale of goods or services. That is revenue. Okay, so what you get from the business itself, minus the cost, the expenses, that is revenue. Cost of revenue shows the cost of obtaining the revenues from other companies during the year. Okay, cost of revenue, to get the revenue, it should decrease over time. Okay, cost of goods sold, it is the cost of obtaining materials to make products sold during the year. That is COGS. We call it as COGS. All right. Or some retailers, they call it as cost of revenue, or cost of sold. Some manufacturers, they call it as COGS, Some service companies, they call it as cost of revenue. It's the same thing. All right. And then we have gross profit. What is gross profit? Considers revenues and cost of revenues from the income statement. So you minus revenues minus cost of revenue, and you will get the gross profit. Okay, next is OPEX, operating expenses, resources that must flow out of a company if it is to earn revenue. Usually this is during distribution and marketing. Cost of obtaining materials to make physical products sold during the year. Okay, so the remaining costs that are not included in COGS, not directly tied to the production of goods or services. Okay. Um, and then the last one is net income, or we call it as net profit or net earnings. Okay, so these are the things that you should know in income statement. So we have revenues, we have cost of revenues or cost of goods sold, we have operating and net income. All right, operating expenses, net income. Other than that, we have gross profits. Okay, we have net income. Okay. Okay, for the statements of of cash flows, we have three types of statement of cash flows. All right, where the cash flows comes from. All right, so cash flows is whether or not the profit numbers are believable. Okay, so you need to know the cash flow of the company, where it goes, where it comes from. Okay, so cash flow describes yearly cash receipts and cash payments in and out, cash in and cash out. Okay, so three types of cash flows, from where the cash flows are operations, investing, and financing. So what does it mean by cash flows from operations? Okay, concerns main operating activities, cash transactions involved in buying and selling goods and services. You are selling things, and let's say you are selling boba tea. Is that the name? All right, if you're selling that tea, all right, the money that you get from that selling the tea and buying the ingredients of the tea is called cash flows from operation. And next is cash flows from investing. Net cash used or provided by investing. Okay, so investing means at the start of the business you will need to invest some amount of money, cash or land or building to use for the business. So the cash from the investment itself, to open a business, to run the business, is called cash flows from investing. It might be from your own money, from your own saving, or it might be from the investors of the business. Okay, and the last cash flows is from financing. Net cash from all financing activity, including the debt that you have, the equity that you have. All right, equity is assets minus liability. Okay, the dividend payments to the stockholders, for example, and then the salary, repayment of borrowed money from banks, from individuals, from other financial institutions. That is cash flows from financing. So there are three cash flows from which are from operations, from investing, and from financing. To sum up, what you need to know for this chapter is the definition of accounting, who are the accountant, and what is bookkeeping, what is accounting information system, and who are the 5 users of accounting information, and then the types of accounting, and you need to know the accounting equation, the balance sheet, and the income statement, and lastly is the statement of cash flow.